just because you think something's worth a lot more, it is equally true that the valuation can get a bit ahead of itself.
Welcome back to LukeTheTrader, and this time with Ragingbullcap. So could you please introduce yourself and talk a little bit about your background, what you're doing right now, and just sort of a little bit about yourself?
Yeah, for sure. Well, first of all, thanks for having me on. Yeah, so a little background on me. I'm a lawyer by training. So I actually didn't go to business school. I went to law school. I worked as a commercial litigator for several years. I'm kind of doing the investing thing for a while, and then within the last year and a half or so, I made the transition to full time investor. Um, so that means quitting my job and just kind of doing this full time. And I've talked about this before, but it's not that unusual to transfer like the litigation skill set over to investing. I think there's a ton of overlap. And the obvious parts of that are one, obviously a lot of analytical thinking, but also the ability to sort of dive into a volume of information and be able to kind of extract what matters and synthesize that. And so and obviously people have done this before, right? Like the most classic example is Charlie Munger, right? And just kind of being a litigator for a long time and then jumping ship to investing. So I think it's done fairly frequently, and I think it would be probably more common if not for the fact that despite having a lot of overlapping skills in the toolbox, litigators tend to be pretty risk averse people. And so that obviously lends itself to a paycheck and an aversion to making bets. And so it is kind of interesting. If you get to know lawyers, you'll find quite often they have some of the most conservative investment strategies you'll come across, right? So if you're both a combination of if you're a trained litigator and someone who's a little bit more open-minded to risk taking, I think investing is a pretty natural jump. And so yeah, that's my kind of background. And then for the last but last year or so, I've been writing a Substack, which is Raging Bull Investments. Kind of launched a Twitter account at the same time, and I've just been sort of building some relationships through there and writing my thoughts about markets and whatnot. And that's pretty much it. I mean, right now it's just full time investing for me.
Mm. I mean, Peter Lynch talked about it, like about professions, that you don't need a business administration degree or something. You would even do better if you have an art degree than a
Yeah,
simple
yeah,
finance degree.
100%. To be
So,
honest, I completely agree with that. I think not in every case, but in a lot of cases, I think going the conventional finance route is probably a detriment to good investing. And we can kind of talk about why that might be, but um, you have, first of all, you're getting indoctrinated with this idea in business school. I mean, I went to law school, but I did take a bunch of classes in business school, and you get indoctrinated with this idea of efficient markets, right? And so you're sort of trained within a system.
or random walk as well.
Yeah, and it leads you to believe that you don't have a chance of beating the market, right? Which is very fascinating, to go study something only to be told good luck doing it, and yet at the same time, even though you can't do it, you can make a profession out of this by pretending you can. It's always seemed very fascinating to me, and so I think the efficient market kind of hypothesis and thinking, I think blocks people and sort of gives them a lack of confidence that they're ever going to be able to find an edge, and so they just throw in the towel. And then on top of that, you have these, there are other silly things going on in there, right? Like the equivalency of volatility and risk, for example, which I think you talk to people that are trained in the finance industry, and they're consumed with volatility, which I think often can be
Beta.
obvious. Right,
It's
beta,
all about the
exactly.
beta.
Like volatility is your friend, right? Because if you're able to really understand an investment, um, well, you can use that volatility to your advantage, right? By buying when it goes down. And so I've always just kind of found that odd as someone who's an outsider. I always think about risk as kind of the more conventional, like what can I actually lose in terms of
Yeah.
like a capital loss, right? So if you're buying something, that trades at a huge discount to the cash on its balance sheet and has no debt, but it has a lot of beta, is that risky, right? Like I don't think that's
I
risky, but
mean, it helps. It helps maybe perhaps for the quantitative finding space,
mm,
the quants that have to make models. That's where it makes sense because you can put it into numbers, but otherwise it is
right.
a fairly limited model, at least what I
Yeah,
think,
no, for sure.
in terms of finding out what risk is and what risk means and how you can
Yeah.
assess for it.
And obviously the the equation becomes different when you are managing money, right? Because and that's largely the lens I think through which some of this business school stuff is taught through, right? And so if you're managing other people's money and you face a constant risk of redemption, right? Like if your paycheck is based on how much AUM you have and you have a constant risk of redemption, well, then you're highly incentivized to limit volatility so you don't panic your investors, right? And that
Mm.
creates this really bad incentive structure because, and it's what leads to a lot of underperformance in these fund structures, right? Is a constant fear of short term volatility. And so you have a lot of suboptimal decision making, which if you're running your own money,
Mm.
I don't think you need to be thinking about very much. But then kind of going back to these people trained within the industry, I think that sometimes they fail to disentangle like what might be required in a money management context and like what makes sense to run in your own portfolio.
Yeah, there's like a German fund manager who manages like I think 400 or 300 million euros, and all he does is he's hedging against the market,
Right.
and
Yeah.
he's just known within the German sort of space, and he's getting a lot of jokes about it, and he's just a laughing stock at this point.
Yeah. I mean, there's a ton of fund managers, right? Where sometimes you look at like their book and you ask yourself, why are people paying you 2 and 20 to buy Google and Facebook, right?
And then to
Um,
hedge.
yeah, exactly. And it's not that that doesn't necessarily work, and it's worked really well for the last decade, but like it's just a bizarre kind of industry, right? Where there's enough studies out there which suggest mostly passive indexing is going to beat these guys after fees, and yet
Mm.
there's an enormous industry of this stuff, and so there's a real. I just think there's a very major difference between investing to create a business out of it and investing to maximize your returns. Those things are largely, I think, in tension. And so if you come at this business as an outsider and you haven't sort of been, you know, indoctrinated within that idea, I do think you find pretty easily that if you put enough work in and you fish in the right ponds, I think it becomes manifestly clear really quickly that markets are not particularly efficient at all, right? Especially smaller ones.
Yeah, there's a lot of opportunity out there, but people don't like to search for them because it takes
Yeah.
hours and hours and days and weeks and
Yeah,
perhaps sleepless nights.
and if you couple that with a preconception that it's efficient anyways, then why would you even
Mm,
bother working, right? So if you already believe
yeah.
that, you're never going to be willing to put the work in. But if you do believe that you can find an edge by putting in the work, then it becomes obviously a lot easier to do so.
Mhm. And how did you sort of get into this microcap space? Because you already said so. There's at least a lot of hurdles that come at you when you first join, and sort of the preconceptions of the market
You,
itself.
I think, well, it's interesting. I obviously at some point down the road, I realized that I would probably have much better performance if I wasn't doing what everyone else was doing. But how I came to that conclusion, it's not clear. It's probably just honestly spending a lot of time online, discovering like Twitter accounts of smart investors, right, years ago, and just kind of over time getting a sense of like, hey, these guys are actually substantially outperforming the market. I was told that wasn't possible. What are they doing? And you look at what they're doing, and it's almost always smaller stuff. And so from that, you kind of take the dive yourself, right? And you kind of like and also, right? I mean, there's so many publicly traded companies out there that at some point you have to define who you are as an investor, because you're going to have
Mm-hmm.
just way too many options to look at. And so it helps, even though in some cases you may miss good opportunities, right? Like, I mean, I certainly don't own Nvidia and wish
I
I had,
mean,
but
yeah, I mean, just in the Canadian microcap space, within $5 million, there's I think 1,700 companies out there, and that's
right,
just sub 5 million.
right. And
So,
there's no way you're going to do like significant due diligence all of those, right? Although, I mean, you could probably just pass on most of them within like a few minutes of looking at, right?
mm,
But that's exactly right. Like just in that one sub market, there's enough, right? And so if you just don't define what it is you're looking for, you're going to find it impossible to make any decisions, right? So in my world, I just said,
mhm,
hey, like, if it's large, unless there's some screaming obvious opportunity or something, I'm not looking at it because I don't have the time, right? And then it becomes a question of like, what is the best use of my time? Like, am I more likely
mm,
to find a mispricing looking at mega caps or at micro caps? And obviously, the answer is micro caps. And so, why bother? Even though, as I said,
mm,
you might miss something like Nvidia. Not that I would have
mm,
found that necessarily, but there are moments where it's frustrating that maybe, hey, I probably could have looked at that, but it just doesn't work that way. You just need to know. You need to define what it is you do, and then just stick with it, because um, you won't have an ability to function otherwise, right?
yeah,
Like,
yeah.
so
Otherwise,
that,
you get frustrated from the market and say, "Oh, this is better, this better." Then you change your
right,
tactic, and in the end, you're
exactly.
you're worse off.
Yeah, so you had this like huge mega cap rally the last 6 weeks, and I'm sitting there in a bunch of stuff that's not working. And if you haven't defined yourself as an investor, you might be inclined to say, well, I'm out of all this small stuff. I'm going to buy the mega caps. And then,
Mm,
the last 5 days, that's completely reversed. And so you would find yourself in a situation where you're just kind of hopping around chasing themes, right? And it's better just to, it's just, I mean, I don't think anyone's ever had success doing that, right? Like
yeah.
you have to have some kind of criteria that define you. Um,
Mhm.
yeah.
I mean, where do you look for value currently within the market, the
Um,
microcap space and everything?
yeah. So I think there's a ton of it right now, more than I can possibly do the work on just on my own. I mean, as we were kind of talking about before we recorded here, like right now I'm looking at a lot of publicly traded real estate companies, um, because I one of those sort of things I think that defines me as an investor is I try to be counter cyclical, and so I'm looking for things, not always, but I'm looking for things that haven't worked for a while, right? It's like, hey, why is this at an all time low right now? And that might be, there might be a reason for that, but oftentimes there is an overdoing of the sentiment in both directions, right? And so I think right now one of the really interesting setups is in some of the smaller publicly traded real estate names. And so, as particularly in the US, you have super strong supply and demand fundamentals in certain parts of the country. It's like the Northeast, for example, where you have kind of a structural shortage of housing. You've got rents going up, really high occupancy, and a difficult development environment because of cost inflation. and what are already pretty low cap rates. And so that that theme with large cap multifamily REITs, I think, is pretty much already priced in. Like people know this, but there are certain pockets of that where, for whatever reason, it hasn't worked, and one of those reasons is anything that's touching office at all, right? Like it's so ridiculous. Where even if you had, say, 10 buildings and one of them was an office, the market's probably puking you out right now because there's just no appetite for that, right? And then you have what usually accompanies, like, toxic underperforming assets are concerns of leverage. And so I've been kind of spending a ton of time looking at some names that are benefiting on one hand from those strong supply and demand fundamentals, and that's clear. Like, you can see that without really doing any work. You can see these companies have growing net operating income, and are also underperforming pretty significantly in the market. And it's probably because they have office and look over levered. So, like, actually, I think the last company that I wrote up on my blog is a REIT called JVG Smith, which is concentrated mostly. Its assets are concentrated pretty much in the Washington, D.C. area. And it's recently transitioned through what I think is like really good capital allocation from what was almost exclusively an office company into now what is majority multifamily. And its multifamily assets are performing exceptionally well. Office assets, on the other hand, are not so great, but they're slowly kind of finding an equilibrium with respect to the office stuff by bringing a lot of stuff out of service and through some foreclosures. And what's really interesting there is they essentially have a monopoly over this area called National Landing. And as a result of that, they, as the kind of, development monopoly, have control over the supply of, pretty much all the real estate. And so when you have that, you have an ability to sort of create an equilibrium within the asset class. And that's what they've been doing, right? Like, they're bringing office stuff offline. No one else is bringing it online. And so as a result of that, as they keep taking things out, you should get some stabilization. And they have, and again, this is kind of usually accompanies it, right? Is they have what looks like somewhat threatening leverage. But if you kind of peel back the layers, what you see is it's actually not that levered at all, because the way they've structured the debt is such that a lot of it is tied exclusively to the asset that it's mortgaged on. And therefore, if they simply foreclose on the asset, that debt doesn't have any recourse against the corporation and its other assets, right? And so you actually, when you kind of look at what they can do with all that optionality, you see a company that's actually maybe even under-levered and has really strong fundamentals. And it's actually started to turn a little bit as we speak. Like, in the last couple of weeks, we'll see if that lasts. But it's trading at what I think is an enormous discount to the value of its assets. And it's really rare to find setups like that, like what I kind of call like quality plus deep value, right? Where you have like distress, but at the same time, like a very good company, like some really good assets run by really smart people, trading like it's I mean, it's gone better, but it was almost looking like it was insolvent a few months ago. I don't think it fell down to $13 a share. It's back up to 17, and I think the net asset value is like at least 25, right? So it's a huge discount. And I've made that one a pretty big position, and I think it'll probably work out really well over time. Like, I do kind of see that as an opportunity to own something potentially for like a very long time. And generally, as I said, I kind of tend to hold things for a while unless the thesis is explicitly about some kind of short event driven trade, perhaps. But here, I do think, and history teaches us this, right? Like if you buy quality real estate when it's cheap and no one wants it, and you hold it for a long time, generally end up doing really well. So like that's been a huge part of my focus. There are other companies that I've been looking at that have kind of similar dynamics, like Howard Hughes, for example, and then my little micro cap REIT called Clipper. But yeah, that's been a big part of my energy for the last month or so. Um, and then yeah, as we talked about, I think before you started recording, is I wrote a piece, last month, which kind of took a dive into the places I'm looking right now. Real estate was a big part of that, but I also mentioned some coal names and then just small caps in general, right? Which until the last week, where I think the Russell's up like 12% in the last 5 days. But prior to that, it was just like everything on my watch list, everything that I own felt like it was probably way too cheap. So I think there's a ton of opportunity right now.
And because you're sort of a bit of a contrarian, do you ever look into timing a stock, because it is essentially vital? I mean, you don't have to hit the peak or the trough, but essentially being close or like somewhere there is
Yeah. So
oftentimes enough to yield a good return, right?
yeah, so I don't know if it's time. Like I guess it is in one sense timing, but what I'm really looking at is just valuation, right? Like discount to fair value. And so I might have a situation where I'm watching something and I'm like, hey, this is getting really cheap. I think it's worth 10 and it's worth 4 or something. And I'll buy it. I won't not buy it because I think it might go to 3. Like I won't do that because I just don't know if you can have any. I mean, how are you going to know, right? You never know. And so what I usually try to do instead is just to scale into things. So, something is just a falling knife and it's at 4. And again, I think it's worth 10. I'll buy some. And then if it goes down to 350, I'll just buy more, right? But I won't just sit there and watch something I think is already a really good deal keep going, because you never know when you might miss it, right? Like, and at the end of the day, if something, if you think something's worth 150% more, does it really matter if you save yourself, an extra 10% on the buy? Like, obviously, it'd be great if you could tick the bottom, but I don't have any confidence in my ability to do that, so I don't. Although, what I will do sometimes is, and this isn't timing, right? But I do have like a watch list that I look at pretty frequently, and the B names that I'm somewhat familiar with on there. And then if I see like, hey, this thing seems to be really getting hammered, then maybe I'll start getting more interested, right? But again, that's kind of a valuation thing and not a timing thing. And a good example of that, right, is the company I just mentioned in passing, which is Clipper. Like I thought, it's just gone from I think 10 down to I think the low is maybe 340 last week over the course of the last couple of years. And I thought it was cheap at 5, but I thought there were other things that perhaps were a little bit more interesting. And so I just kind of watched it. Then when it got into the 4s, I started getting interested and started buying some. I think my first buys were probably at like 450. And then pretty shortly thereafter, the stock at 340, right? So I'm down big already. But then I just bought more because if I liked it at 450, I should like it at 350. Absent anything that's changed, which nothing has, right? It's just kind of sentiment, and you can get that sometimes, particularly in like lightly traded microcaps, right, where it will just keep drifting down for no apparent reason. So yeah, I mean that's kind of my view on that, right? Like I definitely have um, a fetish maybe for averaging down. Like I'll keep buying, which sometimes might get me in trouble, but that's generally my approach to it, right? Because I don't think anyone can time the bottom, right? So if I miss it, I'll just buy more, obviously within reason. And sometimes I'll also like I'll average up too, right? Like buy it at 4 and it's like still cheap. I'll buy more at 450, whatever. Like I'm not particularly fussed about that, and like it's my own money, right? So I'm not like the portfolio management aspect of it. I think sometimes is less important to me, right? Like I don't care if the stock falls 20% right after I buy it. But the way I tend to mitigate this kind of stuff is I don't usually ever buy my entire position all at once. It'll usually be like a sequence of buys over time.
And what sort of criteria do you use when you determine your next winner? Is it I don't know, do you look primarily at the balance sheet? Do you look what do you look at? What is sort of the most important metric for you? Is it
Yeah,
ratios? Is it just simple numbers? What is it? Is it
yeah.
future projections? I don't know.
I don't know if it can be boiled down to anything specific, right? Like I do for kind of I probably as yeah in an age where like the asset light model is really exciting to everyone, I probably appreciate hard assets more than a lot of value investors right now. But again, like I mean, two of my biggest positions, BQE water and Cipher Pharmaceuticals, are as asset light as you'll get. So I don't really rule anything out on that basis, but I definitely more times than not um, do like to have kind of some hard asset backing when I buy something, and that a lot of that kind of comes down to a margin of safety, right? Like if you're buying a balance sheet, oftentimes you can be a little bit more comfortable with the downside, and when you're buying, some of these asset light businesses, they tend to first of all trade for a decently high multiple. Um, And so if things turn, you can also run into a lot of trouble. And obviously, something that goes from 15 times cash flow to 7 is a huge loss. Uh, and so I just get a little bit more comfortable with hard assets, but I I definitely don't base my universe on what I'm shopping for based on like any specific gauge like that. And just to kind of go back, maybe if there's one thing that I do tend to focus on, it's things that are pretty out of favor at the moment. Um, and when you do that, these specific like um, features like balance sheet, like discount to like cash and stuff like that, they just tend to emerge because stock is so out of favor. So maybe it's less that like I'm looking for a net or something, and more that I'm looking for things that no one wants, and therefore it's a net. If I can maybe put it that way. But in terms of like, what drives like a fundamental long for me, because I do some like event driven stuff, but for a fundamental long, like what I usually want is I want something that can give me like a power law return, right? So like I don't want to buy something because I think it's going to go up 30%, right? Like I want something where, hey, this can have like an outsized return over a long period of time. So maybe the word for that is runway, right? But there's this kind of interesting um, like feature of sort of looking at just like, and this kind of goes back to the JBG Smith thing, right? Like looking at almost distressed like companies that have some underlying quality that I think is going to emerge. And therefore, you can really generate that crazy upside while sort of protecting your downside, right? Like, I want to buy, like, I don't just want to buy, and I do this sometimes, um, but just like a shitty company because it's really cheap, right? Like, oh, this is a net, whatever. It's like, there's a discount here of like 30%. I'll buy it. Sometimes I do that. But what I would prefer is to have that discount with some kind of quality such that I can hold on to it for the long term. And so that's I guess probably my favorite situation. Right?
Mm-hmm.
That doesn't come around that often, obviously.
Mm-hmm. You already started sort of about talking about your big positions, and one of them is BQE. And Could you perhaps explain your investment theory and sort of how you see performing into the coming future?
Yeah, sure. So BQE is a Canadian microcap, largely undiscovered. I think it's getting a little bit culty now online, but what they do is water management for mines, and so essentially what happens is most mining projects will have some element involving water, and that water gets contaminated through the process of mineral extraction and in recent times, yeah, selenium, cyanide, whatever, there may be various chemicals that contaminate it. And in recent history, governments have enacted a lot of regulations um, mandating that mining companies deal with this contamination in some way, right? Like they can't just have it run off into the rivers or can't store it on site. And so BQE provides technology to these companies so that they can treat the water. And what's particularly interesting is they have sort of brought a new operating model to this service. And so historically, what they did was they would actually create the treatment plant, like hold it as inventory and then sell it to the mining company. And now they've transitioned to what is entirely an asset light model. And so what they do is they go into a mining project that's being in the phase of permitting or development, so not online yet, and they'll work with the mining partners to devise a solution for water treatment. And if and when that mine does go into development, the mining company will put up the capex to build out this water treatment plant. So none of the capex comes from BQE. They're just kind of there to consult and to develop the technology. And then once that mine goes into operation and that water treatment plant is up and running, BQE charges like a recurring revenue, something that's almost like a royalty stream off of this water treatment plant. And these treatment plants, for the most part, will run for the entirety of a mine's life, which could be a decade or more, sometimes 2 decades. And sometimes they'll even have to keep the treatment plant on post closure, right? And so you get these potentially very long streams of recurring revenue. Um, and my sort of thesis looking at the company initially was, it's in the very early stages of this transformation. A decade ago, and kind of leading up to the last few years, the principal stream of income for the company arose out of these joint ventures in China, whereby they're doing water treatment, but it's a very different model. And so what would happen is through the treatment process, they extract some of the metals that contaminate the water, and principally that's copper. And they would take the copper, and then that copper gets sold, and BQE would make money based on the price of copper, right, or based on the value of the copper sold, and obviously that has some cyclicality to commodity prices, and so it wasn't really a great business. And now this new sort of avenue of just treating water and then charging per unit of water that gets treated is a much more stable, less cyclical business. And the market isn't really, in my view, pricing in the runway here, right? Because the recurring revenue stream is now it's inflecting. It's becoming the majority of the company's revenue. It's also growing, over 100% a year. And they break down for shareholders kind of the average economics per water treatment plant. And if you run the math, you can see where this thing might go in a couple of years. And it's one of these situations, and it's a little bit actually unusual for me based on what I'm saying, right? Because this is certainly, there's no hard assets involved here, but it's also something that doesn't look cheap at all. You look at it on trailing numbers, right? Like and this is like a lot of pushback I think people give to the idea, right? Is it's trading at I think it's almost 20 times earnings, maybe a bit less than that. And then like on an EBITDA basis, which I prefer to use for this company, and we can kind of get into why, but it's double digits. But I think what people fail to do often, and definitely in the microcap space, right, is think like, what does this look like in the future? And if you go out a couple of years, just stacking on the incremental contribution from new recurring revenue streams, which the company sort of gives you a framework for doing, you can see that, maybe by 2026, we're buying this at what is maybe only 5 times EBITDA, right? And for a business that's asset light, has no capex needs at all, doesn't carry any inventory, and also has no debt, 5 times EBITDA is actually very, very cheap, right? Like this is a kind of operating model that warrants a much higher multiple than that. And so while it looks maybe like it's fully priced right now, I think the stock will be up a bunch in the next couple of years. And kind of after I started, writing about the company, it perhaps got a little bit ahead of itself in terms of valuation. Like I think it went from $40 to almost 70 in the span of maybe 6 weeks, and it's since pulled back a fair bit. I think today it's maybe around $57, $58, and that's okay, right? Like just because you think something's worth a lot more, it is equally true that the valuation can get a bit ahead of itself. So I think more or less is probably trading at the right place right now. Like I think it's going to be worth a lot more, but I don't think the market will give it that valuation until the financials start showing it, right? So we might be another year out, but there's another angle here which is totally missed, I think, by investors, and that's that the company has what they refer to as company maker projects. So these are like extra large recurring revenue projects, and they've got 3 of them in the pipeline. Uh, and we don't really know the specifics, although I did write a piece where I kind of, I think, got pretty close to figuring out one of them. And that one, at least, should contribute the same amount of recurring revenue as the entire company is earning right now. In other words, it will double the recurring revenue, just one additional project, right? And then you have super high incremental margins. You've got kind of 50% EBITDA margins on a project level, and a corporate SG&A that doesn't really need to scale much, right? So you get operating leverage from these projects, and so I do think it's going to probably work out really well, but it might take a bit of time.
Mm-hmm.
Yeah.
And as we're sort of at the end of our interview, do you have anything that you want to perhaps highlight or remark?
Just generally,
Yeah.
yeah. I mean, those are kind of the most pressing things on my mind right now. I mean, I'm always turning stones over, right? So I kind of, I run with a portfolio that's maybe like 10 to 15 stocks. It's a little bit more than that right now, and people have been kind of teasing me about that because I talk about like, hey, I could try to be really concentrated, but what's happening right now is I'm just seeing a ton of things that I just feel like I need a piece of. So a lot of these are, I have more positions right now than I'd like, and some of them are smaller. But yeah, I mean, I'm generally running, ideally 10 to 15 positions, most of them kind of long term holds. And we've talked about a few of them, and I'm happy to talk about anything else, but those are kind of the big things on my mind right now.